Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Hey everyone, and welcome back to another episode of the Finance Garage. As always, Jonathan Wu here, Senior Financial Advisor and Principal at the SWU Group. And today, I want to talk to you about something that almost never gets discussed, but affects nearly every retiree in Australia. It's this: the biggest financial risk in your retirement may not be markets, inflation, property, or even super. It might actually be your adult children. Now stay with me, because once you understand why, you'll see how a few smart decisions today can protect both your kids and your retirement lifestyle. When we talk about retirement risk, people immediately think of market crashes, interest rates, inflation, living longer, or medical costs. But here's the quiet truth that no one talks about. Retirees don't live financially alone. Your children's financial problems can become your financial problems. If your adult children are highly indebted, underinsured, stretched with mortgages, living close to the edge, then one bad event in their life can immediately spill over into yours. And it usually doesn't show up as simply as an expense. It shows up emotionally. The conversations really can start with, "Mum, can you help cover the mortgage for a bit? Dad, I've been sick. I can't work. I'm behind on repayments. Can I borrow some money just until things settle?" Many retired parents will help their kids no matter what, but it can come at the worst time, right when retirees are relying on capital to support their own lifestyle. Even worse, we've seen situations where recently Vanguard came out with their study around how retirees are retiring in Australia. And 50% of those surveyed that are either Gen Xers or baby boomers, 50% said that they believe that when they retire, they will still have a mortgage. And that in itself is quite scary. The modern problem that we all face really is mortgages, which is then compounded by high household debt. Let's look at what adult children, which are usually people in their late 20s through mid-40s, are facing today. Australia has some of the highest household debt in the world, the highest mortgage sizes ever seen in history. We have an ever-increasing rising cost of living pressure, and we have a gig economy, or in other words, an unstable employment situation for many people. And most households are running on pretty thin buffers. 1 or 2 missed paychecks and the stress really starts to add up. 3 or 4 missed paychecks and people really start to fall behind on repayments. And here's the key point. Almost none of these adult children have appropriate levels of insurance, especially income protection. And this is what we call underinsurance. And it's the silent crisis amongst young adult children. We talk a lot more about home insurance, car insurance, travel insurance, and the need to buy that when you've bought a house, bought a car, go away on holidays. But the insurance that matters the most, the one that protects your biggest asset, which is your ability to earn an income, is often ignored. Let me give you a blunt reality. Most Australians aged 25 to 45 are underinsured or, in the worst case, not insured at all. And particularly for different areas, which includes income protection, total and permanent disability, or what we call TPD, trauma and critical illness is another one. Why? because they think, well, it's too expensive. B, I'm young, nothing's going to happen to me and I'm invincible. 3, or C, I have sick leave. Or D, I'll sort it out later. But later often never comes. And here's the truth. Your income is the machine that pays for everything else. Lose the income and the whole financial house collapses. Now think about this with adult children. They have a mortgage, a partner or a spouse, kids, car loans, and day-to-day expenses. And if one of them suddenly can't work because of illness or injury, the entire household is exposed. And when they get to that point, where are they going to turn? Of course, to mum and dad. And so when kids get sick, the parents pay the price, regardless of age. Imagine this scenario, and it's far more common than people realize. Your 35-year-old son or daughter, who has a good job, broadly healthy, has a mortgage and a young family, suddenly gets diagnosed with cancer, or they suffer a serious injury, or they develop a mental health condition that puts them off work for months. Their employer might cover a couple of weeks of leave, and maybe they have some savings. But after that, the bank doesn't stop asking for mortgage repayments, right? The kids still need food. The bills keep coming. Life doesn't pause. And then you get the call. Retirees tell me all the time, Jonathan, I had everything planned, but then my daughter needed help. Jonathan, we paused our retirement travel so we could support our son. Jonathan, we had to take money from our pension account to help with their mortgage. Unfortunately, the emotional burden is heavy, and the financial burden can be even heavier. So, what we don't talk about is the solution, because most people don't want to talk about it, and that is insurance for your kids. This is where the conversation starts to shift, because people often think insurance is something they should pay for. Why should I pay it for them? And fairly, normally, in normal circumstances, that's true. But you have to think about strategically. If your child becomes sick or injured, you're going to end up paying anyway as the parents, either through ongoing support or in a lump sum or by derailing your own retirement plans. So the real question then becomes, would you rather pay $50 to $150 a month for your children's income protection, or potentially pay thousands per month to support them if things go wrong? For many retirees, paying the premiums is actually the cheapest and smartest form of risk management. And here's the other advantage. I always remind clients that income protection insurance especially is honestly cheaper when they're young. A 28-year-old in good health, what we know as a clean skin, gets much lower premiums. 2, they're more likely to be accepted with no exclusions. Pre-existing health conditions creep in fast when you start to get into your 30s and 40s. 3, it protects your retirement assets indirectly. You're insulating your retirement savings from unexpected calls for help. And it also protects your grandchildren too. These policies obviously help maintain stability for the whole family unit. And remember, if you are so lucky that if you have this conversation with your kids and they say they'll pay for it themselves, well, there's an even larger added bonus. One of the ways the government actually encourages all of us to have income protection is to effectively apply, and then the premiums for this policy are actually tax deductible. So let's say, for example, your policy costs you $2,000 a year and you're a clean skin and you're on a 47.5% marginal tax rate. Guess what? Your out-of-pocket after-tax cost of that policy is just a bit over $1,000 a year, which really, if you're thinking about the biggest asset, which is your income, well, that's going to be about the same cost as the average car insurance policy. So at this point, you might be thinking, oh, yeah, I understand the benefits of income protection, but I've got other forms of insurance, right? Because most people focus on life insurance. But for working adults, the more important cover really is income protection. Because unless you actually cark it, that life insurance policy doesn't pay. The reality is that you are far more likely to become ill or injured. You are far more likely to need extended time off work. Income protection pays an ongoing monthly benefit. It keeps the mortgage paid and it keeps the food on the table. And it protects against long-term financial spiral. Income protection is the thing that keeps the financial engine running while your child recovers. And remember, when the engine stops, parents become the backup engine. And that's why this matters. So if you're now sitting here and you've listened to me talk for the last 10 minutes and you think, well, I think this is a risk that I need to sort out. It's something that I should have a chat with my children about. How should you approach this conversation with your adult kids? Obviously, this is quite a sensitive topic. No one wants to go up to the children and say, hey, you're my biggest financial risk in my retirement. You might get sick and I'm going to have to hack it. That's obviously not going to go down well. Instead, your approach could be more focused on care, not criticism. Here's a simple 4-step framework. Step 1, start with empathy. You could say, hey, I know how stressful mortgages and family expenses can be. And then in step 2, introduce the idea of protection. I want to make sure you're protected if unexpected happens. Then moving on to step 3, you can then start framing it as a family safety net. It's not about the money, it's about ensuring stability for your family. Final step, always offer to help. We're happy to help with premiums if you need it. It's much cheaper now and it gives us all peace of mind. Sometimes adult children say, Mum, Dad, I don't need it. But then you say, I hope you'll never need it, but that's exactly why we get it, just like why we buy home and contents insurance or car insurance or travel insurance.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
Let's talk about a couple of real-world examples, right? You've probably seen these scenarios among friends or colleagues. A young parent diagnosed with cancer, unable to work for a year while seeking treatment. You've got a tradie with a back injury, suddenly earning nothing. A teacher starts to suffer severe anxiety, needing extended leave. Or a professional, yes, in their 30s or 40s, it does happen. Or a young couple with a mortgage, suddenly unable to meet repayments. In every case, the financial pressure falls on the extended family. I've seen in my 20 years in advice, I've seen retirees drain tens of thousands of dollars, pause travel plans, delay renovations, or reduce their own pension withdrawals because their adult children needed help. But this is all very preventable with proper insurance. So in closing, let me bring this home. The message is protect your kids, which means protecting yourself. The biggest risk to a retiree today is not share markets. It's not inflation. It's not living too long. It's not medical bills. It's the financial vulnerability of your adult children. And if your kids are over-leveraged, uninsured, carrying big mortgages, with young families, and with only 1 or 2 incomes, then your retirement is far more exposed than you think. But there is the solution. Help your children get the right insurance, especially income protection, while they're young, healthy, and insurable. I had a client, I still do have this client, and it was one of the first clients I took on in my early 20s. And they were a clean skin. And I talked to them about insurance and income protection, and they didn't really take too much notice until he got married, had their first kid, and I basically forced it upon him and said, mate, you've got to consider insurance because you have no idea what's going to happen health-wise. And I gave him for the same reasons as I discussed earlier in the episode. He listened to me, we put in income protection insurance. 3 months later, he had a massive seizure, got admitted to hospital, and he was diagnosed with multiple sclerosis. Terrible outcome for the family. But thank goodness he was still relatively young and therefore it was treatable. And MS nowadays, if caught early or starting from early age, there are treatments that help you control the symptoms. Now here's the thing. If he was 3 months late in acquiring income protection insurance and MS had already peaked or reared its ugly head, he would either have to face either uninsurable situation or a loading or an exclusion, and none of those are good. So the earlier that you take out insurance, the cheaper it is in the long term because you are covered for your existing medical conditions at that point in time. And at that point in time, he didn't have MS. But later on, being diagnosed with MS, if he was to make a claim, the insurance company broadly would pay it out, right? Barring any other, conditions which would impact the policy. But broadly speaking, because MS started after he engaged the policy, then he would be covered, right? Because if you get it right, it protects them, it protects their families, it protects you. And that is smart financial planning. That's intergenerational risk management. And that's what today's episode is all about. So thanks for tuning in. I hope you found today's episode helpful. Share it with your family, especially your adult children. And as always, you can reach me on all the socials, and always happy to take feedback at jonathan.wu@simon.com.au. Remember to listen to the end of the podcast for the disclaimer. And as always, this podcast is for entertainment purposes only, and we are not giving any form of personal financial advice. So remember to stay safe, stay smart, and I'll catch you next time on the Finance Garage podcast.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.